So one of the things that I have alluded to in the last slides is that there could be new types of financing instruments. And so, you know, when I started thinking of blockchain was in 2015, I thought, wow, this is actually an opportunity to create new types of assets. And so I tried to talk to my colleagues about it, and I tried to talk to numerous people about it. And I wrote a paper together with Katya Malinova on how you can trade these new assets. But we wrote this paper in a vacuum, essentially. At the time, there was really only Bitcoin and Ether that could be traded. And, you know, we got a lot of pushback from our colleagues. They said, it's never going to happen. The brokers are not going to allow it. Nobody's going to buy these assets. And then, of course, you know, this happens. You know, look at this graph, right? So this is the cumulative amount of tokens that have been sold. So from mid-2016 to it goes only 2018, there was an enormous amount of blockchain tokens that were sold. And these are not necessarily cryptocurrencies. They were actually to finance a particular type of service and good. So in total, just by mid-2018, there were $25 billion worth of tokens were sold. That's that's not a large amount if you think of market capitalization and so on and so forth. But if you relate this, for instance, to the Toronto Stock Exchange, right? Toronto Stock Exchange is total as a market cap of $2.2 billion. $2.2 trillion. So clearly 25 billion is nothing in comparison. But if you look at the venture exchange, which is the junior market, which is for small firms, and these tokens that are being sold are for small new entities, it's only 41 billion. And that's something which has accumulated over a time period of 25, 30 years. So this is an enormous amount in relative terms, right? So a lot of money has been poured into these tokens, and these have been issued. So clearly this is something that's happening. Now the token sales have sort of petered out a bit because most of them turned out to be not particularly useful. So that's a separate story. But the new thing that we see is DeFi, right? Decentralized finance, and the financial services provided on the blockchain. And this market as a whole sees a similar explosion in activity. And the difference I would say there is that many of these tokens were ill-conceived because they were issued by people and they didn't really know what they were building them on. But DeFi is actually a decentralized financial services. It's a new thing, and it is the core of what the blockchain is designed to do, which is value transfers. And so even though some of these projects will not work out, there will be some that will work out and that will matter. Now, if you look at these tokens though that have been established, and many of them are still around, the returns that people earned on them is quite spectacular. We're talking about thousands of percentage points in return. So clearly there is, a lot of people get actually quite rich on this one. But the ugly truth is that many of these token sales were actually scams. So you have two graphs here, right? On the left-hand side, this pie chart shows of how many of these tokens that were issued and offered at the time were actually scams, and outright scams. And you can see the fraction is about, 3/4 of them were really outright scams. In my Twitter feed and also my Facebook feed at the time in 2017 and 18, there was just a permanent onslaught of tokens that were being offered to people and peddled to people. And as I said, most of them were scams. In fact, there was something called the useless Ethereum token. So useless ET, UET, right? You can search it up on the internet. Where basically the person who issued the token said all that he would do is he would take the money from you and buy himself a flat screen TV. Now at some point this project actually collected on the order of $500,000. So it's quite a substantial amount, and you can buy a lot of flat screen TVs from that one, even though the person was extremely outright and forthright with it and said, this is a scam. I am not using it for anything other than enriching myself. Go figure. Now, now let's go back to this graph. So this little slice here, which actually went into trading, where these tokens were actually issued eventually, many of them have already died. Some of them were lingering, and only a small portion of them were actually succeeding. So if you look at the number of projects that failed eventually, now usually startups, or a large number of startups fail or pivot to something completely different. the usual rate is that within what is the first year or so, about 25% of startups fail. For the ICOs, it was 65%, and so the rate is staggeringly high for these ICOs, for these token issuers. Be that as it may, on the other hand, and I just should say, if I look at this next one here, this is just another ranking of tokens, and it's hard to see, but so you would have to look at the slides yourself. If you look at the returns since opening, all of these projects that you see are basically, they still exist, but they're basically, the token price is all close to zero. Right, and the returns is negative, almost negative 100%. So all the money that you put in is lost. As I said, it's not unusual for startups to fail, but in terms of the tokens, there were many of those that failed. Now, one of the things to keep in mind here is these tokens don't exist in a vacuum, right? So there are still laws that apply. Now, entities issued these tokens thinking that by calling them tokens as opposed to assets or stocks or equity, they could circumvent regulation. And the answer is no. A simple thing to say is, if you touch somebody else's money, you're subject to financial market regulations. The end. You take somebody else's money and you use it in some form, you have an obligation to people, you have reporting requirements, so you can't do it. The more specific argument is the so-called Howey test. It goes back to a very early case to determine whether the US Supreme Court determines what a security is. And there's other tests that people have in different jurisdictions. Canada sees an asset differently from the US, from Germany, and so on. But the basic idea of the Howey test is this. What is a security? It's an investment of money in a common enterprise, so it means that multiple people put money into one pool. There's a reasonable expectation of profits coming from this investment, and this is important, the profits are derived from the substantial efforts of others, so not yourself. So, and if you think about many of these assets, tokens as they were issued, they clearly fall under this. And it's just like the argument of many of these issuers say, well, but this should be something legal because reasons, right? And then give you some reasons. No, it's not how it works, right? This is not how the law works. So the basic key is you cannot collect money from people, and you cannot collect money from just anybody, and then think that you don't, regulations don't apply to you. They do. Okay. So now, on the other hand, we should think about them. So forget about the fact that these are scams and that people try to circumvent securities regulation, all of that. But let's think about it as economists for a moment and say, what are the lessons that we can learn from that stuff, right? So, yes, there were, people issued tokens which were clearly securities, but people also were willing to buy them, right? So what does that mean? Now, let's look at the numbers. Since 2016, people were willing to spend, this is again different types of data, so I collected at a different time. There was several $1 billion worth of money that people were willing to put into early stage startups. So there's clearly an appetite for it, right? The venture market that also has early stage firms, although more advanced than many of these ICO, these token firms, collected, in 2018 only $2.2 billion. So it's a tiny amount of money relative to what this market had. On the other hand, you have private markets. In Ontario alone, they raised about 70 billion just in 2017. So a huge amount of money. So what do we learn here? First, there's a significant interest in this type of investment in this type of firm. Secondly, there's a real appetite by retail investors. And this money, this 31 billion, didn't come from funds. They came from normal people. And so there's a real appetite by people to put money into early stage firm, right? Now, what's the problem with that? And say, okay, so what? Well, actually, retail investors, normal people, have a very hard time putting money into small stage firms. They actually, more or less, by regulation, excluded. Try to find, now Uber has been went public, but you could not invest in the most profitable tech companies. Right? The only time you can invest is when they went going IPO. But an IPO, you can argue, well, most of the value has already been, created. So you basically don't pay for, you don't have much upside potential. Also, one thing we learn here is that it's possible to raise funds directly from retail investors. You don't have to go through brokers. Now, this is also important because an IPO is extremely expensive, right? So the estimates are, it costs you 10 to 15% of firm value to do. If you go even through the private market, there also the cost that you have is about 10% of the money that you raise goes just to the intermediary, just to facilitate the transaction. So that's huge, right? So, you know, and these ICO firms, what they try to do is they try to circumvent these costs, you know, apart from scamming people. But for those that were legitimate and honest and so on and so forth, basically what they could do is they could avoid an enormous amount of costs. Now we also learn, and I think that VCs and intermediaries provide a service, because many of these firms, as I try to argue, have failed. Whereas, you know, there's a smaller fraction of firms that fails when it's backed by a VC and when it went through the scrutiny of an intermediary. So, in other words, this wisdom of the crowd doesn't really work very well, right? So we have to be honest about that. And money, and just issuing money, doesn't substitute for you know, the knowledge that you have of what is a good business plan and what the advice of a VC can create. So the big question is there a way for us and for the world as a whole to replicate the services that are provided at a lower cost point? Now, another question that arises there is there any merit to these financing tools, generally speaking? So these tokens as a financing tool. Now, the next question that we may ask is if there is any merit to using these tokens as they were issued as a financing tool, and is there anything different about it? And we're going to talk about that in detail too in the DeFi class. But the basic headline announcements and headline news for the FinTech class are that you can finance, if you structure these tokens cleverly. These tokens are actually not debt or equity, right? They actually could have a different functionality. And if you structure them in terms of a financial contract properly, you can actually finance projects that you could otherwise not finance. So in particular, you could not finance by equity. Number one. Number two, the issuance of tokens can create network externalities and actually enable new business opportunities. So what they create is a commitment for people to use a network. And what that does is it allows the creation of not just a platform, but of a community where you can have exchanges happening that otherwise, if you basically go with pure self-interest and transactional view of the world, would not be possible. So in other words, the way to think about this is like often when we go into business relations, we think of them as transactional, right? So I pay you, you give me, right? What tokens can create is a different type of thinking, which is like, okay, so there's still the transaction occurring, but you have some skin in the game for future transactions to occur. And so by investing in a token, what you will do is you have an incentive to use this platform more, which creates more business opportunities. It's possible to do it that way. And then also there's other ways where it also allows entrepreneurs, however, to extract more surplus, both from consumers, but also, circumventing financial frictions. So these are all some insights that we've already obtained. And the important part about this is that tokens, properly designed, not as equity or debt, but they could have, and they already did have, a transformational aspect. So they're not just disruptive and doing things different, doing things at lower transaction costs. They actually change the way things work. So this is economically extremely exciting. All right, let's talk briefly about what these tokens are and how we should think about them. And there's a way how we need to classify them. Now, the way to do it is to think of it as referred to as a tech stack. Most of you have not heard about this. Once you work in industry, you actually hear a lot about tech stacks, right? So what the tech stack really is that different firms provide services for different levels of activity. So let me explain this with blockchain. So there is, or for anything, there's an infrastructure layer, right? So the infrastructure layer really of a blockchain is like the Ethereum network. It enables transactions, enables the execution of code. But then there's also a service layer right? So now the service layer is one where you use the infrastructure and create a product that then eventually applications will use, right? So now this all sounds very squishy. Let me explain this again. So Ethereum is essentially an infrastructure. A service layer is one like a wallet, right? The wallet allows you to make transaction, and what it does, it uses the infrastructure to enable interactions. And then the application layer would be, for instance, an exchange, right? Where tokens are being traded. So that is the direct application. Or it could also be a game, right? So you have your wallet, you use your wallet to pay for tokens that you use in a game, in the application layer. And so the tokens, as they're being issued, they can be issued for the operation or for the financing of various different levels. So, obviously they have the cryptocurrencies that could be issued, as an internal reward system. And Ethereum was essentially an ICO, if you want, right? It was a crowdfunding campaign. And in fact, at the time, it was the world's biggest crowdfunding campaign ever. On the service layer, this could be paid as an incentive, the tokens, but they also could just be a simple usage fee. And on the application layer, we really think of tokens mostly as a usage fee. And so they can be issued in all of these, right? So now on the infrastructure layer, we usually think of it as a cryptocurrency. And in all the other layers, we think of them as a token, okay?